Welcome, everyone, to another episode of the None of Our Businesses YouTube show and podcast, a show that we do weekly and post related to current events in business from an accountant's perspective, actually mini accountant's perspective, because with me, as always, is Charlie Zigmund and AJ Wheeler. Hey, guys.
How's it going, man?
Hey, everybody.
All right. Well, we're going to kick it off, get into some articles, and start out with Charlie. Take it away, man.
All right. I've got an article from Inc.com called Why More Companies Are Offering a 4-Day Work Week. And so obviously we're all in the midst of this pandemic crisis and everybody's trying to adjust to the new normal of, working from home and that sort of thing. And we talked on the podcast a couple of times about different ways that companies are coping with this. But one of the ways is that they're trying a 4-day work week so that they can distance out how people are coming to the office and make social distancing easier. And apparently there is a new data from ZipRecruiter that says that postings that involve a 4-day work week are up 70%. And so I guess I want to get your guys' take on whether or not you thought that 9 to 5, Monday through Friday is kind of the ideal work week, or whether you think that divvying up that time in a different way is superior.
Well, I think it all depends on what industry you're in. If you're in an industry that requires you to be there 9 to 5, and you're having forward-facing interactions with clients and such, then I would say you probably need at least somebody available Monday through Friday, like 8 to 5 or something like that during normal business hours. But if you're like a back-end service kind of provider or something like that, where you're not you're in IT or something, or software development or something like that, I imagine you probably could work odd hours, or something like that. I mean, even in our company, there's some employees that work different than an 8 to 5 kind of schedule. I myself like that schedule, but I think it's probably just industry dependent probably at this point.
Yeah, one of the things it brought up was that some of the people are proposing, instead of 4-day work weeks, maybe like a weekday, or having the weekday end at 3:00 p.m. instead of 5, and then having that be the way that they redivvy it.
Yeah. Well, what I thought was interesting, I guess what struck me, and probably not a material part of the article, but the graphic for the article, it showed Monday, Tuesday, Wednesday off, and then Thursday, Friday. And immediately what came to my mind is that's not how anyone wants to do it, right? I mean, this 3-day work, the 4-day work week, everyone either wants to take Monday or Friday off, you would think, right? So it was interesting, but I thought, well, that would be cool for productivity though. Like you're getting some rest throughout the week. That probably works great for boosting the restfulness and the coverage and the productivity from the company standpoint. But I bet like the vast majority of employees want it to make it like a 3 days off at a time.
That's interesting. Yeah, I guess it depends on kind of what stresses you about, a lot of work. Is it the repetitive, nature of being there 5 days in a row, or is it how many days you have in between? It's kind of interesting. Yeah.
Yeah, it's funny you say that, Charlie, because I thought of the same thing. I thought if my Wednesdays were off, I would probably be, it wouldn't be a restful time for me, because I would just rack my brain about everything that I need to get done that I didn't get done Monday and Tuesday, but are coming Thursday and Friday. So I don't necessarily know if that would be stress reducing for me, or like, wow, a day off in the middle. I too would want to load it like to the front end or the back end, so I could give a middle finger to Monday or Friday, but that's just me.
The only other thing the article said that I wanted to kind of call attention to is that it talked about how people are stating they're more productive working from home than their distraction-filled offices. And I just found that like particularly kind of offensive, because like working from home has been very difficult with distractions. And so to think of the office as like, this place where you can't get something done, it feels strange to me right now. But
well, that's funny, because when I saw that, I totally thought of you, because I was like, yeah, somebody who agrees with me, because I mean I'm with the author of the article on that. I actually get more done on my own at home than I do, but the reality is of that statement is that it's actually different person by person, and there's lots of folks like you, Charlie, that say that exact thing, that they're more productive in the office because their home life doesn't, and their setup, it doesn't lend itself to being more productive at home than in the office, so to speak.
Yeah, it seems like the biggest factor is if you have kids. I mean, if you have kids that are of an age where they still require a lot of attention, then that's just a difficult scenario. But yeah. All right, you got another article we can talk about?
Well,
AJ?
actually, I was going to say, I think it highlights how personal these kind of choice, like how personal all this stuff is. And I think we're seeing like that one size doesn't fit all. There's not like, there may be people that enjoy being in an office setting 8 to 5, Monday through Friday with interaction to keep them motivated to continue working at a certain pace or something. But then there may be people that are very self-starters, that would like a distance style work from via Zoom or at home or something. And then I think you point out whether or not you have kids or distractions at home that are not just video games and TV or something, that actually are little humans running around that could interfere with your work day. I mean, I think they're all factors in it, and it really highlights how what a personal kind of driver working from home or being productive means to a worker. All right, the next one, the one that I have, and I think you guys will probably get a kick out of this. This is a article that's from her name is Lauren Fogelman, and she's a price and profit coach, business success solution provider. And she wrote an article that says the high cost of discounting your services. And this is really like framed toward an accounting firm, CPA kind of bookkeeping kind of business. So the kind of tagline is offering a discount to clients may seem like a great idea, but it actually comes with a high cost. And she explains why you should avoid the discount model and offers some like alternative strategies you can use. And so she says, basically you're navigating your initial consultation. And what happens is when you discount your fees, so, say usually this is going to cost so-and-so, but we're giving you a discount here. And she's saying it can actually backfire on you. People don't see it as an attractive, like, oh, they're trying to get us in by giving us a discount. It shows a lack of confidence, that the first impression is basically one where you're discounting your own worth or rate. The client may see that you have a lower value to them. So basically you're commoditizing your service and not sticking by your guns. And then also too, she kind of relates it. Now I don't know if I'd necessarily reduced integrity, that the price and the rate is linked somehow to reducing authority or credibility. And then also too, price over service, where discounts spotlight prices rather than expertise. And then lower profits. I mean, she's basically just saying if you continue to discount your services to get your foot in the door, and you have somebody that takes you at that face value of accepting that discounted price, you have a harder time turning that around and charging them quote unquote full price for what you're looking at. Anyway, I'd like to get your guys' take. I know we've talked internally about this before, and I think on the podcast, but I'd kind of like to think, is she way off the mark here, or do you guys kind of agree with what she's saying, or maybe have some insight as to different reasons why you shouldn't be discounting your services?
Yeah, I mean, I think this is a topic that I love. One of the topics that kind of plays into things that I love to talk about in terms of running firms and firm operations and things like that. But I think I would say I agree with pretty much everything she said. I think there's nuance to it, and sometimes the things that are being said about, hey, don't discount your prices, become these kind of superficial sayings that it can be easy for people to disregard and say, yeah, that sounds good, but it doesn't meet reality if you don't get into the nuances of it. And I think I've had an evolution on this over my career, because I've worked in environments where I was either not the owner or just one of many owners in a firm environment. And I've worked in scenarios or early on as a manager, I think in a public accounting setting and more than one public accounting setting, where discounting was a constant thing that happened all the time. And I think in that scenario, then the effect of discounting a particular client doesn't necessarily impact you as much, because you're discounting a lot of clients across the board. And you're not really thinking about how that one particular client ranks to your others. But I think as I've become more experienced over time and been fortunate to work with you guys to build a practice where we can deliver a high rate of value, and we can actually get the rate that we want to get a lot of the time, it really puts discounting in a totally different context, because it means that if we're discounting, that's a minority situation. And when it's a minority situation, I'd say I really do feel it more, because then it's like, well, we've committed to do good work for a client and we're doing it at a lower rate than we normally would get. I start to resent it, especially if it's a longer term client, because it's like, well, we're doing similar services for other clients at a higher rate. Why are we doing this? Why, and I think it creates over the long, at first, yeah, it gets the deal done perhaps or makes you feel like it got the deal done. Maybe, and I think that's one of the things the author was talking about that I appreciated, is maybe it didn't have as much to do with actually closing the deal as just appeasing my own emotions and wanting to not face the anxiety of the negotiation over price. And so I could just get past that by offering a lower price. But it's like a momentary gratification that you got out of that anxiety for that moment. And then particularly with the kind of clients that we work with, it ends up being a long-term commitment then at a lower price. And it doesn't make for a great relationship that way. So I would agree with a lot of what she said. And I'd say I'm generally against discounting in those regards. I did want to comment on one nuanced thing, though, that related to something that she was talking about and what I saw in one of the comments there. And this goes to kind of those kind of things that you hear all the time in our industry about why you shouldn't discount or whatever. And the comment was something, her point was, well, you don't want people to be shopping price. You want them to be shopping expertise. That you don't ultimately want people to choose you because you have a lower price. You want them to choose you because you offer a better value. And I totally agree with that point. But then in the comment section, somebody said something that I think was kind of playing off that to some extent and saying, yeah, any client that ultimately you land because you were a lower price, or that any client that ultimately you had to negotiate and get to a lower price is going to be a bad client. And I think there's a nuance here that I would say that is not universally true. And so when we talk about wanting people to choose you for expertise versus price, I would frame it this way, and I would say price does matter, right? There is a market value for the work that all of us do in some regard, right? And so let's suppose that there's an engagement that you could objectively know that if this person were to shop it around, all providers who are highly qualified as we are would do that engagement, let's say for somewhere between $8,000 to $10,000. Okay, and if we go in and we price that engagement at $15,000, I would say price matters in that case. And I would not suggest that the fact that the client doesn't go with us because our price is too high means they were inherently a bad client. I mean, we were out of the range of what the value of that service is by any kind of market comparison, right? So I think the nuance to understand here is, if objectively you could know, and I'm saying that carefully because a lot of times we can't know this, right? But if we could know that the market rate for a certain project is somewhere between 8 to 10, and that's somewhere in that range is what everyone's going to be quoting, and we quote 10, and the client comes back and says, well, I'm not going to choose you if you quote 10 because I know I can get it done for 9,500 or even 9,000 or whatever, right? Some lower amount. Then I would agree. In that case, in that situation, the fact that they're valuing $500 out of 10,000 or 9,000 more than the expertise we bring to the table is a red flag warning sign, right? And so I think when people talk about not price should not be the main point, that's the story that I think has to go behind that discussion. That's the context and nuance of it. Of course, because if you don't have that context, simply saying price doesn't matter makes it easy for people to say, well, of course it does. We're not going to listen to that advice anymore. That doesn't make any sense. And so yeah, of course, price matters. You've got to be within market range. But if you're getting down in the determining factor, if you're within market range and the determining factor is what is not a very large amount of money that the client wants you to basically not charge them in order to get the business, that to me is where I would agree that price shouldn't matter at that level. You're in range, all the other quotes are within range. If the client still thinks that price matters at that point, then I would agree that might be a problem, a red flag for working with that client.
I also might point out, Ty, that maybe it's a little bit kind of like service offering, right? You can think of like a tax return firm or an audit firm, almost like I don't want to use the word commodity, but they're very like boxed in. You know what you're getting for an audit, you know what you're getting for a tax return. And I think probably if you have a client that's already engaged with you and they're looking for another service, like say you're an audit firm and you already have their financial audit, but now they need a 401k audit and they're shopping for a 401k audit, and they come back to you and say, your bid was $500 more than the lowest price bid that we found. Could you do it for that price since you're already our financial audit firm? I could see a situation like that where you're like, okay, I'll meet that price that that other provider offered, where it's kind of an apples to apples comparison. Now you kind of contrast that with like the services we offer where it's not really like a commodity or like a fill in the box, round peg and a round hole kind of situation where we're offering and have the ability to give you more than what like a bookkeeper or just a FP&A person could give you. I think then probably an accounting firm would need to show their worth in that situation, and you wouldn't want to drive down the price just because to get that client.
Yeah, I agree completely. And I think the article pretty much hits it on the head. The only other things I kind of wanted to add are that sometimes you drop your price for a reason that is a good reason, that's a real factor. So like an example of that would be volume. And if somebody's buying a lot more of something from you, then that's a totally valid reason why you're adding in a discount that I don't think gives up any, shows that you have no confidence or anything like that. I think it's just a matter of pricing to the factors that are true in that situation. And then the other thing I thought about is it's a common negotiation tactic to anchor, to start out with some higher number and then to try to give room for for it to be decreased. And so I think in that case, if I look at discounting a little differently than I would somebody who came in at the exact price they wanted to be at, because I don't think it's the same decision at play. And so, yeah, I just thought those were some points that they didn't quite make that they didn't talk about much.
I think Charlie, that concept of anchoring to a higher point and then negotiating, I mean, that is kind of, you got to read the culture of who you're kind of working with in that scenario, because I think that's what the author was getting at when they talked about credibility and integrity, from the standpoint of, I think for some folks, that is the issue, is that if you come in at a price and then it turns out that that's not your real price, then it suggests that, oh, does this person have integrity? Can I believe what they're going to say? I think for other people, they understand that this is a negotiation. It doesn't, what happens here in that regard doesn't actually reflect on other transactional issues that we'll be working with. So it's not a broad statement about somebody's integrity or credibility because they are anchoring and then with the expectation to negotiate, because that's just how the pricing game is played among some people and in some cultures. And so I think being sensitive to understanding whether that what that means, right? And I think what you kind of just hit on there is that the author maybe was being too narrow in their perspective about what that kind of price negotiation would mean depending on who they're working with.
Yeah, I think you bring up a good point because, it didn't fully click with me how it would be such a loss of credibility. But now that you put it that way, it does make sense. You come in with one price and then tell them something totally different. Does anything you say matter anymore? It makes sense.
I think also too, probably like our industry, talking about the accounting industry, probably has like an overall feel to, or at least traditionally, like traditional CPA firms offering tax or audit services probably has like a traditional kind of company or even pricing culture to it, and like how the owners kind of price their offerings. And I think that's probably what most of these articles and the vast majority of accounting posts on like LinkedIn are pointing at. I want to do a good job and help my client out kind of thing. And often that means sacrificing personal gain. in the form of margin, where they discount their services because they know they can help this client and they really want to. I think that's probably where most of these like stick to your price, don't discount it kind of thinking comes from. And I think we're probably going to see that change a bit when these offerings move away from that traditional kind of CPA role, and you see more firms offering services like what we do, or a different spin on what accounting is.
Well, I think you hit on it a minute ago, AJ, that this discussion about price and sticking to your price and the arguments being made, there is an assumed prerequisite here that you're doing something that is not a commodity. And I think, and as I've railed about this in prior podcasts, but that is like, there is this common theme in our industry of trying to get accountants to be trusted advisors, and everything's kind of mushed together as if they're all foregone conclusions that you're going to be all of those things. You're going to be cloud-based. You're going to be a trusted advisor. You're going to do value pricing. You're going to look at fixed pricing, and you're not going to be a commodity. And I think that the reason I reject that, even though I believe in all of those things, the paradox is I believe in all those things, but I reject that because the truth is most firms are not all of those things. And self-awareness is really important. It does you no good to be taking the advice on pricing in this article if the truth about your practice and your firm is that it is a commodity-based practice. You'd be far better off admitting who you were on that first, and then if that means you have to match other people's prices to play a commodity game, so be it. But you can't get into this discussion about the pricing the way we're talking about it if what you do is commodity. So knowing who you are is a prerequisite before you even get into this pricing discussion.
And I think that's probably something that's underappreciated or underdone in the traditional accounting firms, is to take a long, hard look at what you're offering, how much you charge for what you're offering, and then, basically like really core defining services you're offering. Usually it's like, we can do whatever you want. And we've picked up clients where they went to the guy that does their tax return is now going to do their bookkeeping, for instance. And the fact of the matter is they're not set up and they don't have a process for handling that bookkeeping side of things, because you're one of maybe 5 clients that they have that needs that service from you. And they're not just, they're set up to be a tax return firm, but now they're striking out and trying an outsourced or a placement style accounting service that they don't have experience in, and they're not set up to manage and to provide value to the client.
Yeah, it's all about understanding your own value proposition. I mean, what is it how are you going to be better than somebody else at what you're doing? Is it because you do a lower price, or is it because you provide a better service? And are your objectives in line with, your actions on that? So I've got an entirely different article we can talk about on a whole different topic from The Verge called Tesla Sues Rivian Over Alleged Trade Secret Theft. And so what's been going on is apparently that Tesla has been finding a disturbing pattern of losing its trade secrets and confidential information to former employees. And it seems like a lot of those employees are going to different EV startups, electric vehicle startups. And there's one called Rivian, which has had it's the biggest one. It's gotten $5 billion in funding in the last year and a half, and is positioned to bring out all these new cars, sooner than Tesla. What they found is that I think it was a staffing manager had emailed details from the company about practices that the company uses to find people, candidate information, lists of potential clients, and that sort of thing. And they had taken it and emailed it out of their work email to their personal Gmail. And then Tesla saw that and filed a lawsuit in regard to it. And it's been one of a few different cases with different EV companies. And sometimes somebody files a lawsuit and you're not really sure if they're upset. But in this one, it turned out that they actually wrote that the actions were despicable, wanton, oppressive, willful, malicious, and duplicitous conduct. And so you kind of just sort of know that they're very mad about what's happening here, and they would like to get it fixed. And so I want to get your guys' take on, it just seems like a difficult thing to regulate because on the one hand, so much of, sometimes you look at intellectual property and it's very obvious what it is. It's names of clients and that sort of thing. And then other times it seems like somebody emailing something to their personal email from work might be difficult to define where it breaks the line. And so I guess I want to get your guys' take on what can companies do to, be clear about those policies or, protect themselves from this type of problem.
Actually, I was kind of surprised to see this article because in the beginning of Tesla, when I was kind of paying close attention to Elon and his musings and stuff, one of the things he said was he wasn't going to patent any of this stuff and it was free to use for everybody. It was kind of like a blanket statement, but I think what he was referring to was the battery and drivetrain technology. And so the supplementary things like the software and all of that stuff is probably open game. So it was confusing to me, but I think intellectual property is probably one of those like litigious kind of areas where I think there probably needs to be some reform in how that's implemented, especially with software and stuff like that, because it's probably not the patent and trademark process is antiquated for paper. We're not talking about digital goods and such.
I think it's particularly problematic in an industry like this one where they're solving new problems. It's an emerging industry. They're different companies solving new problems, and so you have engineers and people working for one company trying to solve problems, and then they move over to another company to solve similar problems. And wink, wink, nod, nod. They're supposed to not, take things that they were using in the old company to help solve the problems in the new company. And I mean, where do you draw the line there? As Charlie asked, I think is where it becomes particularly difficult, right? I think there was a statement in there that Rivian, that competitive company, said that, well, they had a policy where every new employee came on had to sign paperwork or documents that said that they would not use technology from their prior companies in the solutions they were developing for Rivian. And and I think that's the idea, right? But that's where you're that is the fine line, right? Because certainly they must be using their knowledge of certain things that they have learned in their work at prior companies in order to solve problems at the new company. So I think that part's tough. I think what's interesting though is that the actual case of an HR recruiting person taking confidential information from the company and then bringing it in. They're not just taking their industry knowledge or their learnings or their way to solve a problem. They're actually taking like data and bringing it over. I think that part is easier to kind of look at and say, hey, that's not cool.
Well, and it seemed like a mix of both because in the article it lists that it mentions candidate lists as an example, which that to me seems like a pretty clear breach. Information about where the automaker finds potential hires, which that one's getting a little questionable, right? Because if I know this is too ridiculous an example, but if you just know of all these different job websites that people post to because you worked in HR, and you go to some new company and utilize one of those websites that you learned about while at Tesla, seems like a strange thing to get, upset about. I'm sure that what's going on here is far beyond that, but, it's hard to tell from the article. And then he said another example was a detailed internal write-up of an executive level candidate. And so that seemed like, again, another one of those things where, that's in your head as you learn that. And so it's difficult to divorce yourself from that information as you're moving on to some other opportunity, I guess. So
I always saw in a lot of industries, it's common for people to quote unquote poach somebody from their prior job. It's kind of looked down upon, but it's not a legal kind of action if somebody poaches somebody and offers them a higher salary or something. So the job finding or the hire finding kind of aspect of this lawsuit I find interesting. It'll be interesting to see what happens in the lawsuit too, how the court rules in this, because it might set a precedent for this.
I don't know about the legal enforceability of it, but in our industry for manager level and above employees, it's actually quite common to have a non-compete in the contract in the employment contract, and it often will say not only can you not work for clients for a certain period of time after you leave this, but it often will say you cannot recruit any of the employees at this existing company. That would also be a violation of the non-compete. Because I mean, in our industry, that makes sense, right? Because that's what we do. We bring people together, we train them, and we deploy them. So poaching the people is a pretty serious issue. To your point, it happens, but I think there's a difference between a colleague who leaves a firm and happens to know some friends that may also be interested in this other company and introduces them or whatever, and a leader in the firm who leaves with like a full employee roster that gives the new company a punch list to go down on who to recruit. Those are kind of different, right? In terms of how you might look at those things. So yeah.
And I think that might be the theme. I think it's all context and also position, right? To Ty's point, a staff accountant at a Big Four firm that then has his buddy come over to the same firm that he just moved to probably isn't looked down as much as like a manager or a senior manager bringing his whole team with him, when he leaves, or attempting to bring his whole team with him when he leaves. And those two things are vastly different, I think.
Totally. And just to hit on that point, because I think you bring up a great point about context. In the article, it talks about how one of the things that mattered was that staffing manager we're talking about had taken a job at the other place 3 days prior to the day that she then decided to send all this info. And so it's kind of like the lead up of events. It plays into that context that we're talking about.
Yeah, it's probably not the best look, huh?
Yeah.
We'll see how it plays out. So I got another one for you guys. And this will be interesting. I wanted to get your guys' take on it. So this comes from Politico, and it's called The Death of the City. And teleworking, not the coronavirus, is making urban living obsolete. And this is actually something that even like 5 years ago, when I was in public accounting, we had employees that would move closer to downtown because our office was in downtown, and it would strike their commute. And so, and what they're basically saying, they're kind of comparing and contrasting to a ancient town 700 years ago in Tuscan town of Siena that was basically like a banking hub, and it had 50,000 inhabitants, which it was only like surpassed by like Paris, London, and Milan. And then in 1348, there was the Black Plague or the bubonic plague, and wiped out a bunch of people, and it basically caused the collapse of this large metropolitan area. And so what they're trying to do is kind of show that like this move to teleworking and stuff like that is going to reduce the kind of large city and dependent and large metropolitan areas that are present. And I'm wondering if that's going to take hold. Also, too, outside of this article, like a lot of people are leaving California right now. So Joe Rogan had from the Joe Rogan podcast and UFC fame and all of that had announced he's moving out of California for Texas. And it's because of a myriad of reasons, but the overpopulation and the fact that basically he can do his podcast from anywhere. And the fact that like he can't perform in comedy clubs right now is forcing him out of California. Now, this is also, I don't know, serendipitous or actually meaning is that California is set to tax millionaires and large earners even more, bringing up their potential effective tax rate almost to 50%. But I'd like to get your guys' take maybe if we found kind of we've talked about it on the podcast before, and like small startups, fintech startups and stuff, or internet-based startups moving to the Midwest, for instance. And if we're going to see kind of the coast and large, metropolitan areas kind of shrink, or for the, like big city life to kind of move away now that people are able to work, or that now remote working is even more popular.
It seems like it. I mean, it seems like things are changing in that direction, and I feel like a lot of people are not going to have a choice as things, basically if the economy continues to have troubles, people are going to have to move to where they can afford, and that's going to be in those places that other people aren't all living in now. I have kind of an interesting take on it because for the last 10 years, I've been living in a suburb and then going to a big city, Portland. And so I've kind of gotten to see, both sides of the coin on a daily basis. And so, there's a bunch of pros to either one, but it does seem like people are moving more towards kind of that suburban life, or more rural, as they're trying to change, to our economy.
And I think the article mentioned it in one line, but I think you can't underestimate the importance of tax policy in cities and urban settings too, because I think it's often the case that if you're living in cities and urban areas, metropolitan areas, you have higher taxes in a variety of ways. In Oregon and here in Portland, we typically have higher property taxes if you're sitting in Portland proper and in Multnomah County. They've got certain small business taxes and other little taxes here and there for people who are actually in Portland. And then Portland doesn't have this, but there's other locales around the country where they even have their own sales tax regimes and things of that nature in those areas. And so I think about this from the Portland context, and the thing, here in Portland, and I've always felt, well, it's more or less a fair deal. I mean, if you don't like paying those extra taxes to be in the urban environment, then you don't pay them. You don't live here, right? But there were benefits to being here. Some of those being kind of the convenience and the services and the fact that the cafes and the things that are nice about being in that area. And so I do think the virus does have a role in this analysis, because with those things being out of commission, then you start looking at it, and I was just thinking about this myself the other day. It's like, okay, well, I'm paying to be here, but the nice parts of being here are temporarily on hold, and I don't know how long that lasts. And it's, and unfortunately in Portland, without getting into the politics of it, Portland's hit national news. So it's not just the coronavirus itself, but it's also the downtown is on fire every night this summer. And so, without me expressing whether I support that or don't support that or whatever, it's for sure makes it like unlivable in that scenario. And I'm not going into the downtown itself. And that creates a mental block, whether it's rational or not. It creates somewhat of a mental block to want to go in and do anything in the downtown. And so then, yeah, you really question what's the value of being close to downtown? What's the value of paying paying higher living costs and by the way, if you're not a property owner, you still end up paying this toll in some way, right? Because you probably pay higher rents. So we all pay higher living costs to be in these urban environments, and they're just not going to, the service and what they're able to offer aren't going to may not support that. And I think that's the raw economics of it. It may drive people away from downtowns just for that.
One thing you mentioned, Ty, is I used to work at a firm, and they were talking about moving to a suburb from downtown Portland at one time. And one of the reasons they wanted to stay, and one of the managing partner at the time, basically her objection to that was that Portland was prestigious. They had a downtown office, and it was seen as very prestigious, and that, they were kind of central to everything. And now I'm wondering, not just from the protest downtown, but from the fact that like kind of urban areas are not, are not, at least now, seen, they're kind of seen as densely populated, not quite as much social distancing. And I would even go so far to say that maybe a suburb or a less populated area that you have a business in that's still fairly central would be as attractive now, as maybe a downtown location, if not more attractive to clients.
I think in our industry, it depends on where the bigger firms are. I mean, what you just said about what you experienced at another firm, them thinking it was prestigious to be downtown, I've heard that across many kind of local and regional firms that have had long-term presences in downtown. They're and I look at that as you're drafting off the other organizations around you to some extent. Maybe not even if we're talking accounting firms, not even just other accounting firms, you're drafting off the law firms and other kinds of kind of professional service organizations that you want to be seen as being associated with. So I think for the the smaller firms that you and I have experience with that kind of have that mindset, they most I can bet that they're out as soon as the big firms that are out, because it doesn't, right. They're no longer associating themselves in that way when that happens.
I would also wonder if Portland and some of the issues that it's had over the last 10 years would mean that maybe the prestige of having an address or an office in Portland might be tarnished by some of the challenges that it's faced over the years, because I think that the sentiment of Portland has changed a lot in the last decade, or at least from the people that I've spoken with. And so, yeah, I think it's kind of always evolving.
I think there's also another issue, because I think as we're talking about the prestige effect of having a downtown office, let's face what that is. It's a heuristic that's used when there's not a ton of information and transparency into the actual value of the various companies and service providers and what they can and what they can do. And I think that old school business used a lot of tricks like that in order to kind of set up their value proposition and market themselves, because it was just it's a signal, like I said, a heuristic. It's a signal about our firm is a high-end firm because we happen to be downtown. I think that multiple things are happening with the progress of technology and society and culture and business, and one of the things that we see as a trend overall is there's just a lot more transparency and a lot more information out there in the internet age. And I think that the marketing value of some of these heuristics are probably less than they were 20 years ago. There's just, people are able to evaluate companies and professional firms on more dimensions that are available to them and information that's available to them than, they happen to be downtown. But that being said, as late as 10 years ago, I did have a client that literally came into my office because I was in a downtown office. And when I asked them why they chose us, they were like, well, you were right here smack in the middle of everything. We figured that, you must be a credible organization. There is something to that, but I think the arc of that is changing, and unrelated to anything of COVID or anything else we've talked about. I think that issue's alone changing.
I agree. All right, so I've got one more we can talk about from businessinsider.com, and I thought it was kind of a little bit of a different article, but maybe an interesting one. It's called, "If You've Ever Wondered How a Startup Founder Mulls a Giant Acquisition Offer, Read All of the Texts Between Instagram Co-Founder Kevin Systrom and one of his investors after Mark Zuckerberg first approached them." And so what the article is that there's basically been a big antitrust hearing around tech, and it has made conversations available through what's been released as part of that trial that previously weren't publicly available. And so some texts from 2012 between key players of those companies as they were sitting there trying to decide if they should accept an offer regarding buying the company. And so I just thought it was interesting to see these two guys talking about such a big, gigantic acquisition deal. And it's interesting to watch them talk about it in such an informal way, because there's it's sort of a shorthand text conversation back and forth between them. But the subject of what they're talking about is basically big scale negotiation, and whether or not they should involve, how they think that Mark Zuckerberg is going to react to the different players like Twitter and Google that might want to buy the company. And so I guess I wanted to get your guys' take on whether or not you felt like these types of discussions, is this how you imagined those type of discussions would go in big companies like this as they're considering acquisitions?
Well, I think it's also industry specific. I was just thinking about, these guys having this kind of conversation over text, and they're like texting all the way up till dinner, and then it's like, okay, I'll have dinner, and then when I'm done with dinner, they restart the conversation via text. And I was reading through the text, and one of the things I thought was interesting about it was that there was like this, okay, do you want to talk now? Yeah, I'm ready to talk now. And I thought that was going to signal a stop to the texting, but they meant we're ready to just text each other back and forth nonstop is what they meant. And so, I'm not that old, but that just feels like a younger thing to do than even me. And also it kind of is stereotypical of that particular industry as well, that kind of young folks would have this kind of conversation over text. I thought that was interesting. I guess maybe more and more people will do that across the board, but I suspect we would probably see some differences in that in the industry. And so, yeah, but I guess that's not the real question you asked, Charlie, but I just thought I would remark on that.
Well, one thing I noticed, I was reading through the text myself, and I thought was interesting was basically they're talking about the acquisition of Instagram, Facebook, acquiring Instagram there. And what I've seen, at least in the last, I don't know, probably 10 years, is like this homogenization of these social platforms. So, you have Snapchat, and then Instagram releases Instagram stories, and you have TikTok, and then you have Facebook and Instagram offering these short musical skits that are already in there, and Snap offering the same thing. And it's basically, it's to use a bad analogy, it's turning everything vanilla. It all seems the same. You know what I mean? And just in our, in teleconferencing, right? Zoom kind of reflects, the same kind of interface as like Google Meets and all the other things. It's all kind of the same, I guess. But what was interesting was when they're talking back and forth, if I don't dive into this negotiation, is he going to go full destroy mode? Meaning, is he going to copy what Instagram is doing and just stick it on Facebook? And so, like, do I get my value now, and do I try to grow the business separately and do it? I thought it's an interesting that even back then, this is 10 years ago or whatever it is, it was still kind of, you're seeing this homogenization of these technologies come together. That's what I found interesting about it.
And it seemed like they almost cared more. It was almost not even like, how do we extract the most value out of this company personally, as much as the conversation seemed to center around how do we control the future of the product. Like, and because there were, I think I saw somewhere in there where they were talking about, well, what's going to, maybe we can negotiate a deal where that limits what Facebook can do with the product once they buy it. Like, we can set some kind of guide rails around that or something like that. I think that was said. And I just kind of scratched my head and was thinking, from a financial perspective, why does that matter? Why would they, to the way you said it, AJ, I could see, and I guess that also speaks well. I was talking about differences in kind of how they operate and what I would expect. But I think that speaks somewhat well to them, that they're a little more mission oriented than just purely financial oriented, is what I got from that.
Yeah, they specifically said one of their fears is that he would buy it and then shutter the project based on how they had seen that he had handled other deals in the past. And I thought that was really interesting. The other thing I thought that was interesting is that they talked about keeping that specific conversation that they're having confidential. And it was just super fun to read that, as, they're saying, let's just not ever tell anyone that we're talking about this. And so,
well, and I think it probably speaks more to the way these young tech entrepreneurs think, where they're really so invested in the product they're making that they really do believe like it's going to change the world, or we need to ensure that this goes forward the way we saw it, in perpetuity, or at least until we can control it. So it's very interesting to see it not just centered around dollars and cents, what us accountants would think it's about, right? Like how much value can we extract from the company monetarily, but more how we want our vision to remain in place even if we don't own it anymore. And how we can ensure that people are taken care of and all of that. So it's kind of neat to see that different spin, I guess, on the entrepreneurial front of really caring about the product, the product or the service that they're offering to that degree,
Yeah, the other interesting thing I thought is that they both were really quick to say this needs to go slow. They were really quick to exercise caution and hesitation. And that was almost one of the first things. As soon as he figured out what the topic was, he was like, nothing happens. You need to talk. And they mentioned how we think him better than, we think that the other guy knows Mark Zuckerberg better than the investor. And so just kind of seeing their strategy was interesting. But all right, you got another article we can talk about?
For sure. So this one actually is from I want to make sure, Wall Street Journal. So I found a mirror to it, but it's actually talking about, surprise, surprise, the PPP loan, something we haven't talked about in a little while, but we were heavy into. So the title of the article is actually Congress seeks to fix $120 billion tax snafu in the PPP loans. And so at first glance, what I was thinking about was the loan forgiveness itself being a taxable event, where that's, usually when a loan is canceled, that means that amount of loan canceled is taxable income to a business. But in reading it, I had forgotten that was specifically, carved out in the PPP loan itself, that wouldn't be a taxable event. But what they are talking about are the expenses used for forgiveness of the loan, then not being able to double dip that as a reduction in revenue when you go to file your taxes. And as of such now, they've been mute on this whole subject. And surprise, surprise, the PPP loan forgiveness application and kind of the underlying process of it has not been fully ironed out. So everybody's kind of waiting. And I think one of the things that hasn't got enough attention, or one of the things that hasn't been talked about enough, is the fact that, are you able to double dip on these expenses that are basically used to forgive or paid for with a government loan, essentially? Are you able then to deduct that as a normal business expense when filing your taxes? So I think, and the way that the IRS has usually done these things, or the way that lawmakers have put in tax law, has usually been that you get benefit from something once and not twice. So I would be really surprised if they allow this to go through, where you're able to use those expenses as a deduction to revenue. And they talk about the consequences of this, that it's probably about 120 billion in taxes with a B that they're going to miss out on. If they allow this to deduct those expenses to be deducted from revenue. So I'd like to get your guys' take maybe on whether or not you think they should be whether those amounts that were covered by essentially this grant for small businesses should be still deductible, or if this, if it holds true that you get one tax benefit per expense, essentially.
Yeah, I mean, I think to me, the nuance of this, I think for a lot of people, they feel it's straightforward. It's like, well, ultimately, if the expenses that you pay with the PPP grant are not tax deductible, then the value of the grant is really less than what you thought it was. It's really a lower number because net of the tax effect. I think I've been drinking a little bit, so hopefully my math isn't crazy here. But I think that your perspective on this really depends on where you're at. And I've talked about this before. It's like, if you really were using the PPP loan to truly survive, as in you would not have been able to pay those expenses if you hadn't had the PPP money, then I think that you may have a different perspective on this. Because I think that where a lot of this perspective comes from is, let's suppose that let's suppose that you actually would have broke even without the PPP money. So you have, I'll say 100,000 three times here. You have $100,000 in revenue and you have $100,000 in operating expenses, setting PPP aside, and so you would have broke even. You would have ended the year at zero. Well, you wouldn't have paid any tax at that point, right? Because you broke even. Now let's suppose that all $100,000 of operating expenses were qualified for the PPP, and so in fact you got $100,000 of revenue. You actually got another $100,000 as a PPP grant, and then you had $100,000 of operating expenses. Well, what you're wanting to have happen in that case, what everyone's hoping, the entrepreneur is hoping in that case is, okay, I broke even without the PPP loan, but because I got the PPP money, I banked $100,000 that I get to keep in my bank account here, in this business account. And reasonably, that's not a bad wish to have. It's not just greedy. I mean, we are still sitting here in the midst of the pandemic with an economy we don't know where it's going, wanting to have that cash reserve on hand without having to pay a tax on it is kind of a reasonable want. And I think it's that context that really drives this discussion of, hey, it sucks that we have to pay tax then because now what we're saying is, well, we have $100,000 of revenue. We got the $100,000 PPP, so we have $200,000 in the bank. We spent $100,000 on qualifying expenses. Well, we can't deduct that $100,000 because the $100,000 we spent was used to qualify for the PPP. So it's PPP money, right? So we can't deduct it on our tax return, which means that we have $100,000 of taxable income, revenue, no deductible expenses, because all our expenses were technically paid with the PPP money. So we have no deductible expenses. So now we have $100,000 of taxable income. Let's say our tax rate's just a rough number, 30%. Okay, so if we're paying tax at a rate of 30%, I'm making that number up. Nobody literally pays at 30%, by the way, but bear with me. We pay tax at the 30%. So that means that now we're paying tax of $30,000. So we don't have $100,000 in our bank when it's left over. We have $70,000, right? And that's the issue that people are looking at. They're like, well, because we can't deduct the expenses that were paid with the PPP funds, that we have to say we're paid with the PPP funds to qualify for the PPP funds, because we can't deduct those costs, then it looks like we have income to tax. And when you pay that tax, we actually don't get the full benefit of the PPP left in our bank account. We got a PPP loan turned into a grant of $100,000, but because we're going to pay $30,000 in tax, we actually only end up with $70,000 in the company's bank account. And that's the issue that I think that companies are really focused on, that issue.
Well, and why, my question would be, why would they, if it was going to be the intended outcome that everything was going to get taxed once by saying that you can't get a deduction for the expenses that you paid, then why ever put the exclusion in the first place that said it can't, that the forgiveness wasn't going to be taxable income? Because it seems like if the goal was that we're going to get taxed on it, that was already the case by default if they would have just left the loan forgiveness part alone, and then they wouldn't have to come back and make this second statement about whether or not you can deduct things. It just seems like, why would they have written that?
Well, so here's the thing. Let's consider an alternative scenario, because this really speaks to what was the real purpose of the PPP loan, right? The scenario I just described before is our business kind of barely makes it without PPP, but with PPP, we get to bank some cash, okay? Let's think of it a different way. What if your business was completely flatlined by the coronavirus and you had no revenue whatsoever, but you were still facing the potential of $100,000 of operating expenses? You get the PPP loan for $100,000 to pay those operating expenses. Well, the fact that those operating expenses are not deductible doesn't matter to you because you didn't have any revenue anyway. So you don't have any tax. So at the end, you get $100,000 of loan or PPP grant, which you use to pay the operating expenses that it was designed for, and you're not left with anything in your bank account. Okay, but you weren't hurt by that right? Because you didn't have revenue anyway, right? So what this really speaks to is, what were these PPP loans really for? Was it really to help a business that kind of was going to survive without it, but makes it easier for that business to have it? Scenario one, or was it to help scenario two, the business that actually wasn't going to survive without it, and therefore the tax doesn't even matter? And I think that's kind of the big debate. My observation about the PPP is that scenario one is actually the only thing it actually does help, and it's probably in practice the only thing it could help, because the truth is that the PPP was never big enough to actually help those businesses that were going to go out of business anyway. If you were a restaurant or a bar or a retailer that basically was truly flatlined by the coronavirus, this PPP thing did not save you. You probably still went out of business, or you're about to go out of business. So all of the businesses out there that are actually getting the benefit of the PPP loans benefits are either those businesses that were just on the margin, like they might have made it with or without it, or the businesses that clearly were going to make it anyway. They got kind of a nice little bonus here. I mean, I think that's the truth about how the PPP amounts turned out. And this whole tax argument is like doubling down on that truth. It's like, heck yeah, that's what the PPP really was there to do, was to benefit those businesses that were going to survive anyway, and that we're going to bank the cash. And moreover, we shouldn't get taxed on that cash. We should keep it all, right? So, I guess I'm saying that in a way that sounds sarcastic. I don't mean to, because I do. I'm in that bucket. I got PPP funds, and I'd like to keep the cash and not have to pay all the tax on it. So I'm rooting for not paying tax on it. But I do think it depends which scenario you were in as to whether this actually matters to you or not.
And even more so, to go to your second kind of, example there, what really sucks for those bars and restaurants and everything that are on the brink anyway is the fact that they probably didn't even have the payroll to get the loan forgiven. They haven't been able to open up and pay employees with that amount. So now they're on this hook for the loan, which they're probably going to have to go through bankruptcy for, or if they go under. So I don't think it really was. I think you're absolutely right in saying that it really was designed as a boost to those companies that took it, that could use it correctly and continue operating.
Yeah, it was not enough to truly save a business that was getting killed by this.
I'm surprised at your restraint, not as a tax guy, as a tax expert, not to bring in the NOL, net operating loss, in your second example.
No, yeah, I'll stop there. I'm doing numbers off the top of my head. I don't know if Ethan will have to create a diagram for this or what, but yeah.
A bar graph or good restraint, Ty, is what I was saying. Thanks for watching the None of Our Businesses podcast. If you liked anything or disagreed, leave it down in the comment section. Make sure you hit the subscribe button and that notification bell, and we'll see you next week. Have a good weekend.
Thanks, everyone.
Thanks, everybody.